Hi, I'm Audie. Today, we are diving into Macroeconomics Made Simple, a guide to understanding the massive forces that shape our lives. No PhD required. While the word economy can sound intimidating, it is essentially the study of how people, businesses, and governments interact to create the world we live in. Think of this as a bird's-eye view of the global engine that determines whether jobs are plentiful and if your money will buy as much tomorrow as it does today. To understand macroeconomics, we first have to understand what it isn't. Microeconomics is like using a microscope to focus on individual choices, such as why one person buys an apple or how a single business sets its price. Macroeconomics, on the other hand, is like zooming out to see the entire landscape. Instead of looking at one person or company, it studies millions of people simultaneously to identify systemic patterns. It asks the big questions. Why does everything feel more expensive? How many people in the whole city have jobs? It is the study of forces that shape decades, not just days. At its heart, the economy is a loop that keeps everything running. In step 1, firms pay wages to households in exchange for their labor. In step 2, households use that income to buy goods from firms or pay taxes to the government. Finally, in step 3, this spending creates demand, which encourages firms to produce more and hire more people, starting the cycle over again. However, this loop has a major vulnerability if one part pulls back, for instance. If people lose confidence and stop spending, the entire system feels the shock. Production drops, and incomes fall even further, creating a dangerous downward spiral. One of the most talked about concepts in macroeconomics is the inflation monster. Inflation isn't just a temporary price shock. It is a continuous rise in overall prices over time, which means your money loses its purchasing power. To measure this, economists use the Consumer Price Index, CPI, which tracks the cost of a basket of everyday goods. If the basket becomes more expensive, inflation is rising. It is important to distinguish inflation from the cost of living. A country can have low inflation, where prices are rising slowly, but still have a high cost of living if prices are already very high. Additionally, remember that official inflation is just an average. If your specific rent surges, your personal inflation rate might be much higher than the news reports. What drives these prices up? There are 4 main forces at play. First is demand side, where people want to buy more than the economy can produce, often seen during economic booms. Second is monetary, where the supply of money grows faster than the production of goods, making each dollar less valuable. Third is supply side, where disruptions in supply chains or labor shortages make it more expensive or difficult to produce goods. Finally, there are expectations. This is pure psychology. If people believe prices will rise, they demand higher wages, which forces businesses to raise prices, creating a self-reinforcing cycle. The government manages its part of the loop through fiscal policy, which is a delicate balancing act. When the economy needs a boost during a slowdown, the government uses expansionary policy by spending more or taxing less to stimulate growth. When the economy is overheating and inflation is high, they use restrictive policy by taxing more or spending less to cool things down. The government collects revenue through income, corporate, and sales taxes. If the government spends more than it collects, it runs a deficit. While deficits are useful during recessions to fill the gap in private spending, they can be dangerous if they become a persistent habit. When the scale tips too far towards spending, we face the issue of national debt. Debt is only sustainable if a country can pay its interest without needing to borrow even more. If debt gets too high, it eats up tax revenue that should have gone toward infrastructure or education. There is also a difference between domestic debt borrowed from citizens in local currency and foreign debt borrowed abroad in foreign currency, the latter of which is highly dangerous if the local currency weakens. If investors lose confidence in a country's ability to repay, they demand a country risk premium, extra interest to compensate for the risk. Acting as the economy's thermostat is the central bank, such as the Federal Reserve. Their mandate is to maintain price stability, control inflation, and support sustainable growth. A key feature of central banks is independence. They are often metaphorically protected by a glass dome, so they can operate without political pressure from upcoming elections. Their superpower is setting the policy interest rate, which is the baseline cost for borrowing money across the entire economy. This interest rate has a massive impact on your daily life. When rates rise, borrowing becomes expensive. Mortgages and loans cost more. Spending and investment drop, and the economy slows down to help inflation fall. In this environment, bonds become attractive, but stocks and real estate prices often drop. Conversely, when rates fall, borrowing becomes cheap, encouraging people to take loans for homes or business expansion. Spending rises, the economy grows, and investors often push stock and real estate prices up as they seek higher returns. On a global scale, we must look at exchange rates and foreign reserves. The value of a currency is like a seesaw driven by global supply and demand. If international investors want a country's assets, they must buy its currency, making it stronger. A strong currency makes foreign imports cheap for citizens, but makes domestic exports too expensive for the rest of the world to buy. A weak currency does the exact opposite. Central banks hold foreign reserve stocks of foreign currencies and gold to protect their own currency's value during a crisis. International trade is measured by the trade balance. A surplus means a country is selling, exporting more than it buys, while a deficit means it is buying, importing more than it sells. Interestingly, deficits aren't always bad. They often mean a country is growing fast and attracting foreign goods. Alongside goods, money itself moves across borders in capital flows. Investors constantly hunt for returns, higher interest rates and growth, and safety, moving to safe haven assets like U.S. bonds or gold to escape political instability. To see how well a country is doing overall, we look at the scoreboard called Gross Domestic Product, GDP. This is the total value of all goods and services produced inside a country's borders in a single year. However, you must distinguish between nominal GDP, which can look big just because of price hikes, inflation, and real GDP, which adjusts for inflation to show true output growth. If nominal GDP grows 10%, but inflation is 8%, the real GDP growth is only 2%. To understand average living standards, we use GDP per capita, which is the total pie divided by the number of citizens. The economy doesn't just grow in a straight line. It follows the business cycle. It starts with expansion, where economic activity and spending rise, and businesses hire aggressively. This leads to a slowdown, where growth loses momentum and caution sets in. Then comes a recession, where the economy contracts for at least 2 consecutive quarters and unemployment rises. Finally, there is recovery, where stimulus like cutting interest rates brings spending back, allowing the cycle to begin anew. In conclusion, macroeconomics is not just an abstract theory, it is the environment you live in. Your purchasing power, job security, and investment returns are all tied to these global forces. By watching the macro weather, using an economic calendar to track inflation reports and central bank decisions, you can anticipate shifts in the markets. You don't need to perfectly predict the future. Simply by understanding the system, you can read your environment to make smarter, more confident financial decisions. In closing, please note that the information presented in this program is for general educational and informational purposes only. While we have explored the systemic patterns and global forces that define macroeconomics, this content does not constitute professional financial, investment, or legal advice. The concepts discussed, including inflation, gross domestic product, and central bank policy, are intended to provide a framework for understanding the big picture of our economy. However, the macro weather is complex and subject to rapid change. Because individual financial circumstances vary, We strongly recommend that you conduct your own due diligence and consult with a certified financial advisor or qualified professional before making any significant financial decisions based on these global forces. Thank you for joining us for this high-level overview of the economic ecosystem.